Hi, I'm Bill Webb, Partner and Chief Investment Officer at Waypoint Investment Partners. I'm here with my partner and portfolio manager, Ryan Marr, to talk about the Waypoint All-Weather Strategy, a strategy that held up very well in 2018 during a very volatile part of the market cycle. Today we want to cover three things. What is a market cycle and where are we in the current economic and capital market cycle? Second, what is the all-weather strategy? We want to learn a little bit about its history and its background and how it was constructed. And third, why is the all-weather strategy particularly well suited to the current market environment? Before I get into that, Ryan, perhaps you can tell us a bit about your background and your investment career.
Thanks, Bill. I first began my career at a real estate investment trust in Ontario, where I was involved in a number of securitizations, first of commercial real estate. And then while I was completing my university degree, I joined an asset management firm where I worked with yourself for 10 years, where that covered a period where during the 2008-2009 financial crisis and its subsequent recovery.
So Ryan, we've been through some market cycles together, although I've been through a few more given my advanced age. Every cycle is different, although they do have some similar phases. In the first phase, the recovery phase, the economy is coming out of a recession. Earnings are beginning to gradually rise, and interest rates are still flat or declining. In the second phase is the bull market phase, where earnings are starting to rise. Interest rates have started to rise, but at a moderate rate, and the equity market is still moving up quite strongly. And in the third and final phase is the late cycle phase, and that's where things get a little wobbly. Central banks are starting to tighten monetary policy, interest rates are rising, earnings are starting to slow down and even start to decline, and equity markets start to become more volatile and maybe even decline into a bear market phase. So Ryan, what do you think are some of the things to look for when we're getting to the later cycle, and do you think we're approaching that phase of the cycle now?
So we look at a number of macro and micro variables, but in particular we take cues from our investee companies. In particular, evidence of peak earnings and peak margins at these businesses. But in particular, we look for rising debt levels and excessive use of debt to fund M&A, all at the same time when central banks are raising interest rates, which puts strain on balance sheets and income statements. In addition, on the macro side, we're looking at volatility gauges as well as credit spreads, all of which today would be consistent with cycles we've observed in the past, and of which are indicating that we are in fact late cycle.
So given our experience, Ryan, we agree that it's really hard to time the market, and we don't try to do that here at Waypoint. But given the fact that we do believe we're later in the cycle, are there any reasonable ways that you can try to protect the portfolio in more volatile times, or when we may be getting into that late cycle and bear market phase?
Sure. Well, at our core, we are fundamental investors. So we're always looking to invest in companies that generate excess cash flow that is paid in the form of a dividend to investors, with aligned management teams and superior models, economic models that have evidence to weathering a market downturn. But as we've learned from our lessons of 08 and 09, you can be the best stock picker in the world, but ultimately in market drawdowns, everyone loses money. So we look to pair our fundamental core portfolio with that of a long volatility or put option strategy to protect against those drawdowns.
So Ryan, can you explain in layman's terms what a put option is and how they can be used to protect clients' portfolio?
For sure. So a put option is an investment tool that is probably best compared to an insurance policy in that you're paying premiums to protect your portfolio or your capital against market declines. And the key input to the pricing of put options or to the cost of those premiums is volatility. And in later stages of an economic cycle, volatility is generally low, like we're observing now. And you're able to purchase put options at what are lower than average prices over that market cycle period. Being able to pair a put option strategy or an insurance policy with our core fundamental equity investment strategy, which focuses on dividends, allows investors to remain exposed to the equity market without the fear of a significant drawdown in their capital base.
So let's dive a little deeper into this concept of capital preservation. At Waypoint, we believe that capital preservation is of the utmost importance. And why is that? Because when you have a material drawdown in your wealth, it can take an unacceptably long period of time for your assets to recover just to the level they were a few years ago. As shown in the diagram here, you can see that the math can be quite challenging. Imagine that you are at or approaching retirement and you have a significant drawdown in your wealth. This can significantly affect the quality of your lifestyle. And that's why it's so important that at this late stage in the cycle, you have a plan and a strategy to help you cope with this sort of volatility. And that's where the Waypoint all-weather strategy can be very useful for all types of investors. Ryan, thanks for taking the time to talk with me today and for walking us through the Waypoint all-weather strategy. The all-weather strategy is the strategy that we wanted for our families. And for those of you who are interested in investing alongside us and in learning more, please reach out to us at the following contact details. We look forward to talking with you further and serving you in the years ahead. Thanks very much.